This is Barry Knapp with Ironside's Macroeconomics. It's Monday morning, May 6th at 7:15 a.m. Mountain Time. This is the complimentary version of our weekly audio and video summary that encapsulates our primary thoughts from our note. This week's note was titled Comfort with the Curves. We offer this in hopes that you'll become a full subscriber to Ironside's Macro. Comfort with the curves is a reference to the Phillips and Beveridge curve models that really are at the core of how monetary policy is supposed to work, the so-called dual mandate in this country, and how these models are constructed. So if you're looking at the video, you can see this wonky looking scatter plot of the Phillips curve. And the idea was throughout 2023, the unemployment rate actually declined a little bit from 3.6% to 3.4% as wage growth fell from 7 all the way down to 5.2. So that was a stage when the curve was going vertical, supply was adjusting. We had this surge in immigration that caused this painless readjustment post the pandemic policy panic. And left the Fed in a little bit of a quandary. Obviously, there's lots of new Keynesians out there like Larry Summers that said that it was impossible for inflation to come down without an increase in the unemployment rate. Well, the curve is now somewhat normalized. You can see the dashed line again if you're looking at the video. And the idea is since January of 23, the unemployment rate has gone up from 3.4% to 3.9%. as wage growth has now fallen in the non-supervisory, our preferred series, all the way down to 4%. This is a normalization and why the Fed is sensitive to further increases in the unemployment rate. We did get an increase last month, although it was primarily a rounding dynamic. But were we to get 2 more months prior to the July meeting, including a much cooler employment cost index number, which was probably the bad news of last week, was that increase in the employment cost index driven by government employment or government wages. Were we to get 2 soft months, the Fed could actually be in a position to start cutting rates in July, but it's all down to the labor market for us, more so than inflation, although that will clearly be important for the tone for the bond market from this point forward. So through the note, we really dug in on what's going on with the Fed with quantitative tightening. We were incredibly frustrated by the decision to reduce quantitative tightening by more than they had essentially pre-announced in the minutes of the FOMC meeting. Only one reporter asked about it. Powell brushed the question off. The Fed has a vast underappreciation of the 2 most important channels of quantitative easing and quantitative tightening, which is the effect on long-term interest rates, which then in turn affects the capital allocation process, and volatility through their purchase of mortgage-backed securities. And they focus almost solely on this liquidity bank reserves channel. They've caused a deep inversion of the yield curve that's impaired bank profitability. We now have the numbers for return on equity for the first quarter for the S&P 500 bank index. It's fallen below 10, the level that typically causes those stock prices to trade below book. Banks start burning capital, can't provide credit to the economy. This was the story of the 1950s for a chunk of the 2010s after the implementation of Basel and Dodd-Frank rules. And it's just a bad path. And sure enough, there was a leak that the Fed and FDIC and OCC do not intend to change the capital rules in their entirety, as Powell suggested back at the March monetary policy report to Congress. And this would set us on a very dark path. Near as we can tell, the Biden administration is trying to push this through before an election that at this point they look reasonably likely to lose. So that was all not very good news, and we didn't view the news out of the Treasury as being all that great either. In fact, we do think when we look through the various scenarios here going forward and dig through the payroll report, think about the probability of either 10s going to 5 because of supply, and of course we're going to get a quarterly refunding this week, 3s, 10s, and 30s, or and just go through the potential scenarios, which for us, the most probable scenario, although the probability went down a little bit last week, not because of the policy developments from the Treasury or Fed, but because of the softer labor data, the still most high or highest probability outcome is that 10s go to 5, 10-year tips go to 2.5% because of all this supply, and we have a broader risk-off correction in equities and all asset classes, really. So that remains our highest probability outcome. Second highest probability outcome is our quadrilemma thesis, the idea that we would get the unemployment rate to go decidedly above 4, wage growth to fall below 4. In that scenario, we do think there would be a growth scare correction in equities. It would be a buying opportunity, and it would get the Fed started on a rate cutting cycle to 4%. That in some ways might be the best case scenario from a markets perspective, not from a societal perspective. And then, of course, there's the immaculate disinflation idea that goods deflation coming out of Asia would more than offset the fiscal theory of the price level, fiscally driven inflation. That still remains our lowest probability outcome. That, of course, is a good scenario in some ways, but we don't think it's particularly probable, and it would still leave the banking system and small businesses in a fairly tricky spot. We think it's very unlikely the Fed would be able to cut to 4 without deterioration in the labor market. So that's it for me this week. Again, consider becoming a full-time, full paid subscriber. We'd love to have you, and we're more than willing to offer a trial if that's what you need. Barry Knapp from Ironsides. Have a good week, everyone. Thank you.